Boom. Welcome back to Money Mondays.
Monday. Welcome back, everybody. Monday Mondays, which is every Monday, 3:30 Central.
Ish.
Talk about a bunch of different things. We talk about real estate, Ben's hair, and real estate, and Ben's lack of
Being an entrepreneur, Ben's hair.
We are talking about types of multifamily properties we buy.
Oh, I love it.
People ask us that often. We figured, hey, let's do a whole topic on it, and that's kind of what we're going to do. So if anyone has comments, questions, please let us know, right? If you have suggestions for future episodes, please let us know as well. That's how we think of these episodes.
Yeah, we always get feedback, or sometimes we're just picking topics out of a hat. Either way, we want it to be interactive, so we want people to engage. So ask questions, give us a like, give us a share. That's the biggest, thing that we love to see is people enjoying the show, right? So let's hop right into this. So the type of multifamily properties that we buy, right? Now, as we've always talked about on this show, you have to determine your box, right? What do you want to buy? There's certain guys that will only buy A-class deals in primary markets, or you might even be more specific. They only want to buy A-class deals in, say, Houston, right? Our box is a little bit bigger, so we typically want to buy 80s and newer properties that are going to be in primary markets, specifically San Antonio, Houston, Atlanta, and we love to do Florida too, right? Doesn't necessarily have to be some heavy value add play. We do like some meat on the bone. But we can also, get away with just doing a management play as well, right? There just needs to be some kind of component there where we can increase the value, within a year or two, right? So that's our box, right? So, as far as markets that we're interested in, like I'd mentioned, right? San Antonio for specific reasons, Houston for specific reasons, and Atlanta we love as well, right? We've been successful in all three of those markets. We're ultimately based in Houston, so we know that's our backyard. But ultimately what we're looking for is, and this is a little bit different in Atlanta the last 18 months, but, good cost basis in relation to the rents that you're getting, right? If there's a good spread there, then you're typically going to make money, right? Now, Atlanta has since ran up quite a bit in price, as we've noticed in the last, probably 18 months. And even within the last 6 months, it's probably gone up another 20 or 30%. But, those are the other reasons why. But we love Texas and Georgia for a lot of the similar reasons that we've talked about in the past, right? Landlord friendly, business friendly, tax friendly, job growth, population growth. It's got all the major boxes that we check, right?
Absolutely, right. Be smart, right? As operators, we try to do our best to reduce risk, but let the markets help you. Don't try to go into a Detroit if you don't know what you're doing. Don't try to go into cities that aren't growing, right? But yes, people can make money there. It's easy, it's not easy, sorry. With the right process, you can, right? If you know what you're doing. But at the same time, it's also easy to kind of mitigate the risk up front, right? Do your business plan, but also try to let the market help you along the way, right? Yeah. Time helps fix any problems on real estate. It really does.
No, it does.
And so that's only if you're with a growing market. Probably with a non-growing market, it's the complete opposite, right?
Yep.
So definitely something to think about, make your life easier, right? And we've done secondary and tertiary markets, but even in those markets, we still look for growing markets, right? I don't think we've ever done a shrinking market, actually.
No, I wouldn't,
and
right?
We're scared of the one-trick pony markets too.
Yeah,
like Midland and
there needs to be some diversification on the economy, right? And why do we care about that, right? And Ferris just touched on it. If it's got one factory or one industry in it, and say that factory goes out of business or that industry goes elsewhere, guess what? You're screwed. So you need to have some diversification because ultimately what you need in order to increase value and increase the rents at your properties, you need demand, right? You need people moving there, jobs being created, therefore people needing a place to stay, therefore you're going to have renters, right? So you need to understand that, and right? And ultimately we've seen a couple people, they play in Michigan and the Detroit area, but they know those areas very, very well. They know what pockets to be in, what basis makes sense. But for us, right, we're going to stick with what we know, places that are ultimately going on the upswing as far as population and job growth, and that is the Sun Belt. Specifically, even more specifically than that, Texas, Georgia, and Florida, right? So another question that kind of came in on this topic, right, was what unit counts are we interested in? I would say it ultimately just depends on the revenue that comes in, right? Because we ultimately want to be able to manage the deal with either a third-party management company or with our own management company, Disrupt Management, right? And here in Texas, that's how we manage our deals is disrupt management. So I would say that's probably typically 75 to 90 units and above, right? And ultimately, we just closed a 530 unit complex, so I'd say that's probably capping out at about as big as we're willing to go as well, right? Because if you get into some of these really, really big properties, it starts becoming
who's gonna buy it?
The buyer pool starts shrinking pretty significantly, and so I would say probably 530 units is probably about as high as I'm willing to go on the unit count. But it goes back to folks using management companies, right? We're not here to self-manage. We're not here to, me and Ferris are not going to be collecting rents and doing work orders, right? We have teams that do that, right? And you need to have enough revenue to justify that. And then we've kind of seen the sweet spot is 75 to 90 and above, depending on where you're at and how much rents are in that place. So what value add qualifications does the asset need to meet? So I think I kind of touched on this earlier, right? I think in the end, there's a lot of different things.
The one that everybody talks about that's not easy to do is management, right?
Yep.
So management is a value add. Now it's hard to find deals that have real management, right? Especially if you're using third party management. How likely is one third party going to do a much better job than the other third party? Right?
Yeah.
That's one thing. The other one that really we do all day and every day is really interior upgrades, right? What can we do to improve that interior? Usually revolves around kitchen, flooring, paint, right?
Yep.
So think, granite countertops, backsplash, paint. It's really not that hard, guys. And you are looking for ways to be able to push rents, right?
Yep.
And you really want to be able to get probably, if you want rules of thumb, 20% return, right, on your money. So if I'm spending $10,000, I need to be able to get $2,500 in rent increases that year.
Yep.
So that's kind of the most common value add that I would say most people do, right? And again, there can be other things, right? Make it look better, added amenities. All of these things are items to improve a property, right? So you can ultimately get a better tenant, which reduces delinquency, reduces turnover, and maybe even get a premium on the rents.
And one thing that we've been looking at a lot, right? I mean, raising rents is easy, folks. Everybody gets that. Okay, we're going to come in, we're going to put $5,000 a door into it, and we're going to raise rents $150, right? But where a lot of the meat can be is on other income as well, right? So what we're looking at is, are they collecting the fees that are pretty much customary for a certain submarket or, a certain asset class, right? Are they collecting those pet rents? Are they collecting, reserve parking? Are they, doing rubs on their utilities, right? Are they, maybe billing back some kind of a Wi-Fi internet cable package, right? That could drive some additional revenue. Because if you're just focusing 100% on the rental rates, right, you're going to lose out on the opportunities, right? Because right now you're having to squeeze juice in different spots, and other income is a great opportunity for you to just, maybe put some money into it, in order to recoup those fees. And sometimes, I'll give you guys an example, tech package. We're starting to roll this out to all of our properties, not just, the latest ones, but some of our older ones as well, right? It's cheap, right? You're putting a couple USB ports in there. You're maybe putting a Nest thermostat, maybe some kind of an automatic lock or an app that's tied to the lock, right? You can look in August Locks, or Yale has some of those as well, right? But all in, you're probably spending maybe $350, $400, right? On top of that, you can charge a premium of typically $30 to $50, depending on the submarket that you're in. So the return on your investment is pretty strong on that, right? So you should look at those types of additional income things and add that into your value add plan too, right? So, but the easiest stuff is, right, you've got down units, we're gonna bring those online. You've got deferred maintenance, you gotta do that, right? Aesthetically pleasing, make sure that the property's painted, the parking lot looks good, landscaping's fresh, pool is blue. Those things are easy, right? It's digging in a little bit.
They're easy, but not everybody's able to.
No, yeah, you got it. But my point is, these days with where asset values are now, you have to dig into a deeper layer and try to find that gold, right? Whereas before you're just finding gold on the top, right? Now you have to dig a little bit deeper and find it, right? So those are some of the things that we've done and just some examples of stuff. But ultimately, drop it in the comments. Let us know what you're doing to increase the value. We love it. What specific metrics do you like to see when underwriting a property? So I think that this all, once again, goes back to the box that you're in, right?
Yeah.
Because one person's good deal is another person's bad deal.
Yeah,
right?
and like we said, ultimately, guys, it needs to be risk adjusted. It's not
That's
just
a great
about
point.
one deal and one return. It's about how much work and effort are we putting into that deal? How much risk are we and the investors putting into that deal, right? And do the returns make sense? I'd rather buy a very easy, great deal, great location if I'm getting the same returns as the deep value add and not a great part of town.
And we're seeing some of those, right?
No, absolutely.
To give people some examples, right? We're seeing value add deals, Class C properties getting a 15% IRR, whereas you're able to get, maybe an A- deal in a significantly better part of town. It's 30 years newer and doesn't have any deferred maintenance, and it's a 13.5, 14% IRR, right? If you really start weighing the amount of time and effort and risk that's involved in that, I would take the 13.5 all day long, right? And our investors are clamoring for that stuff too. So that's what we're typically trying to chase these days, right? Because value add, the cap rates versus a more stabilized product have almost converged. And now cap rates on value add stuff is lower than an A- deal in some cases, right? So you have to bake that into your analysis. The market has shifted, right? People are looking for meat. And so therefore cap rates have compressed significantly. And you need to understand, does it make sense to buy that 3.5 value add 1970s deal versus maybe a 4.5 on an 80s product or a 90s product, right? So those are some of the specific metrics, right? You're looking at IRR, you're looking at total return, you're looking at cash on cash, you're looking at average annualized return. We've talked about this on those shows. Those are the 4 metrics that are not necessarily the end all be all, but probably at a high level as far as investor returns go. Those are the ones that we focus on the most, but there's other things that you need to take into consideration too to determine if it's a good deal or not, right? So those are some of the specific metrics that Disrupt Equity looks at, and ultimately, let's hear from you guys, right? What else are you guys looking for whenever it comes to specific metrics, right? So ultimately, we're shooting this after the fact, but what are we going to talk about now? What's coming up in February?
Multifamily Investor Network Conference, right? This is our biggest conference. It's here in our backyard, here in Houston. If you're in Houston, or you're in this country, or you're on this planet, which I know everybody else is, definitely come check it out, right? It's should be.
If you're on the moon, don't check it out.
We expect about 500 people there. We're gonna have some fantastic speakers. Tom Wheelwright,
Garrett
many
Sutton.
other people. Garrett Sutton for asset protection, and many other people. It should be awesome.
Yeah.
So, it's and again, it's really meant to be just kind of a neutral place to network and meet people. Right?
Yeah.
Come learn more about this business. Go build partners, and that's how things happen. So we'll see you guys there. Use the coupon code DISRUPT to get $100 off. Prices will go up every month, and from now until the event. So meetings will continue until.
What's that URL, man? Just so everybody knows.
mfinvestornetwork.com. Definitely go check it out.
So February 12th, 2022, folks, you have no excuse. We're giving you plenty of time to plan this out. It's a one-day event. We focus on networking, building those relationships, because not only is it a numbers game, but it's a relationship game. And in a lot of ways, and we've seen this more and more as we've matured in this business, right? The relationships that you build, not only with investors. People think of it's all about investors, right? We put on a lot of our investor network conferences and these different meetups that we do to determine who we might want to partner with as well, right? We're also trying to develop relationships with brokers, right? We're trying to develop relationships with vendors in the market, right? That's important. You need to have those relationships in order to be successful. So don't think for a second that you can do everything from behind a keyboard, because it doesn't work like that, right? And I know COVID, everybody got slowed down, but hopefully by February 12th, 2022, I don't know. Maybe they'll have the Lambda variant, but we don't know. We're hoping not, right?
Come check it out.
Check it out. It's going to be fun. So what's coming up next week, right? And I think we're going to probably have Tarek help us co-host.
It'll be the week after. Next week is Memorial Day, so the week after that.
Right, you're right.
Talking about navigating the closing process in multifamily. Tarek can tell you all about that closing process alongside.
Look at this
maybe
guy.
Ben can point out a thing or two. He might.
So we're probably going to focus a little bit on, once again, on the investor relations side. What does that look like? And then also I can kind of give you guys some insight on what we look for, right? And along the way, and what we're doing at certain parts of the process, right? There's a whole timeline. People are always, that's one, probably the biggest black box for people. And that's nothing that any guru or any training program is even talking about, is what do you need to do to get a deal closed, right? You're just fumbling around and hoping that for the best, right? You might get in trouble and you might ultimately blow a timeline. So we'll give you some insight on that. So, boom. That was pretty good.
Mondays,
so
every Monday, 3:30 Central ish. So if you have any questions or comments, please leave a comment. Let us know. Otherwise, we look forward to seeing you guys in 2 weeks.
2 weeks. All right. Thank you.